Imagine working for 30 years, saving every month, doing everything right, and then discovering that nearly half of what you built vanished. Not stolen, not lost in a crash. Taken, silently, a fraction at a time, by something most people never even notice. This isn't a hypothetical. It's happening to millions of investors right now, in every country, in every currency. And here's the part that should make you angry. The people who know how to stop it rarely talk about it. Because the solution is so simple, it doesn't sell courses, it doesn't make headlines, and it doesn't make anyone rich, except you. No matter what country you're watching from, there's one mistake that quietly destroys more wealth than market crashes, bad stock picks, and recessions combined. It's not talked about in most finance videos. It's rarely explained in a way that actually makes sense. And if you're investing right now without understanding it, you're almost certainly making it. Here is a question for you. When you picture what threatens your investments, what comes to mind? A market crash? A recession? Picking the wrong stock? Those are the threats everyone talks about. But there's a far bigger one hiding in plain sight, and unlike a market crash, it never recovers. By the end of this video, you'll know exactly what it is, why it happens, how the wealthiest investors avoid it, and the specific steps you can take, no matter where you live, to stop it from eating your future. Let's start with a story. Two friends. Same country. Same income. Same investment amount, $300 a month. Same index fund. Same 8% annual return. They both start at age 30. They both invest until age 60. Neither one ever sells. Surprising fact. After 30 years, one has nearly $450,000. The other has roughly $330,000. Same contributions. Same returns. Same everything. A $120,000 gap in whatever currency you use. That's not a rounding error. That's years of someone's life. What caused it? The account type. Nothing else. And here is another question for you. Did anyone ever sit you down and explain the difference between a taxable account and a tax advantage one? Not the definitions. The actual cost. The dollars, or rupees, or pesos, or naira, are disappearing from your future. Here's the mistake. Most people invest in the wrong type of account. Not because they're stupid. Because nobody tells them it matters. Because tax-efficient investing sounds like something for rich people with accountants and offshore accounts in places they've never been. So they open whatever account is easiest. A standard brokerage account. A trading app. And every single year, silently, invisibly, the tax system takes a percentage of their growth. A surprising fact is that over a 30-year investing lifetime, taxes can consume between 30% and 40% of your total returns in a standard account. Not 30% of your original investment, 30% of everything you would have had. So why do millions of smart people make this mistake? It's not laziness. It's not ignorance. It's psychology. The first phase is the present bias. Humans are wired to care about what's happening now, not what's happening in 30 years. Taxes on your investments feel distant, abstract, someone else's problem. The brain literally discounts future consequences the same way it discounts future money. The second phase is the complexity avoidance. The term tax-advantaged account sounds complicated. It sounds like paperwork. It sounds like something you need a professional for. So the brain says, I'll deal with that later, and later never comes. The third phase is the not for me bias. Most people believe tax strategies are for the wealthy. They see them as loopholes for people with accountants, not tools for ordinary investors. Have you ever thought that tax stuff is for rich people? If so, you're exactly who this mistake hurts most. The fourth phase is the invisibility of slow losses. If someone took $5,000 from your bank account tomorrow, you'd notice immediately. You'd be furious. But when taxes take the same amount, spread across 30 years in small fractions, invisibly, you don't feel it. And what you can't feel, you don't fix. Another surprising fact is that the human brain is more emotionally reactive to losing $100 today than to losing $50,000 spread across 3 decades. The math doesn't care. But your brain does, and the tax system exploits exactly that. And here is yet another question for you. Be honest. When you set up your investments, did you think about taxes at all? Or did you just focus on what to buy? I'm about to show you a number that should make you stop this video and check your own accounts immediately. That is the average amount an investor loses to unnecessary taxes over their lifetime. Not a hypothetical. S&P Global published this data across millions of accounts. The average investor, not the wealthy ones, the average ones, gives away $214,000 they didn't have to. In whatever currency you measure your life in, that's a house. That's a child's education. That's years of retirement you can't get back. Here's the twist most finance content won't tell you. This isn't a problem of tax rates being too high. This isn't about politics. This is about account choice. A decision you make once, in under an hour, that determines whether you keep that $214,000 or hand it over. And most governments? They want you to keep it. They built the accounts for exactly this purpose. You just haven't been shown how to use them. So what do the people who keep that money actually do? Let's walk through it, not as theory, but as a specific action plan you can execute wherever you live. Step 1. Find your country's tax-advantaged account. Every major economy has them. USA, Roth IRA, 401k, UK, stocks and shares. ISA, SIPP. India, PPF, NPS, ELSS. Canada, TFSA, RRSP. Australia, Superannuation. Nigeria, Retirement Savings Account. Brazil, PGBL, VGBL. Germany, Register-Rente. South Africa, TFSA. Japan, NISA. The pattern is the same everywhere. These accounts either let your money grow tax-free, or they let you contribute pre-tax income, or both. The specific rules change. The benefit doesn't. Step 2. Understand the 2 types. Type A. You pay taxes now, but never again. Your money grows, you withdraw it, and the government gets nothing else. Type B. You deduct contributions from this year's taxes and only pay when you withdraw decades later. Question. Which type is better? It depends on whether you think your tax rate will be higher now or in retirement. Most people don't know this, so they never ask. Now you know. Ask it. Step 3. Fund these accounts first. Before your regular brokerage. Before your trading app. Before anything else. Max out whatever tax-advantaged account your country offers, especially if your employer matches contributions. A match is a guaranteed 50,100% return. Are you aware that over 25% of employees in countries with employer-matched retirement accounts don't contribute enough to get the full match? That is literal free money, rejected. Step 4. Once the tax-advantaged accounts are full, then, and only then, use a standard account. This is the universal priority order. It works in every country, every currency, every income level. The account names change. The logic doesn't. A key insight to note is that most people do this backwards. They open a trading app, buy some stocks, pay taxes every year, and never touch the tax-advantaged accounts sitting unused. The smartest investors do the reverse. Let's bring this together. What did we actually learn? Lesson number 1. The biggest threat to your wealth isn't a market crash, it's a slow, invisible drain. And unlike a crash, this one never recovers. Once taxes take that money, it's gone forever. What compound growth would that money have generated? Also gone. That's the part nobody talks about. Lesson number 2. This isn't complicated. The financial industry wants you to think that a tax strategy requires a professional. It doesn't. In most countries, the difference between a tax-advantaged account and a taxable one is a few clicks, and a form you fill out once. Lesson number 3. The people who win at investing aren't smarter than you. They don't have secret stock tips. They don't time the market. What they have is the right account type, and they set it up early. Here's what I want you to feel right now: not anxious, not overwhelmed, aware. Because you can't fix a problem you don't know exists. And now you know. The difference between the person who retires with $330,000 and the person who retires with $450,000 isn't income. It isn't luck. It's one decision, made early and never revisited. Final thought. Most people will watch this video and do nothing. They'll feel informed for 5 minutes, then open the same trading app tomorrow. Don't be like most people. The cost of doing nothing isn't neutral, it's compounding against you, right now, as you watch this. If this video changed how you think about your investments, even slightly, here's what to do next. 1. Open your investment account right now. Not tomorrow. Not this weekend. Right now. Which type is it, taxable or tax-advantaged? If you don't know, find out. That one piece of information could be worth 6 figures over your lifetime. 2. Search for the tax-advantaged account available in your country. Not sure where to start? Drop your country in the comments. We're building a global resource, and chances are someone has already shared the answer for where you live. 3. If this channel has helped you think differently about money, subscribe. This is the 4th video in our wealth building roadmap, and next week, we're covering the simplest investment strategy that consistently outperforms Wall Street professionals. You won't want to miss it. Comment below with one word, the country you're investing from. Let's see how many countries we can fill in the comments, and I'll personally respond to as many as I can with the specific tax-advantaged account available where you live. Thanks for watching. Now go fix that account.